What if I told you that in a single month, just 31 days, a medal sitting in your kitchen drawer, your grandmother's jewelry box, or buried in a coin collection in your garage, nearly doubled in price, shattered a record it hadn't touched in over 4 decades, hit $121 an ounce, and then crashed nearly 50%, almost overnight? What if I also told you that America's own Treasury Secretary went on national television and said, out loud, that the whole thing was driven by wild, out-of-control speculation coming from China? And what if the most important question is not what already happened, but what happens next? Because right now, silver is sitting at around $90 an ounce. It's not at the bottom. It's not at the top. It's at a crossroads. And where it goes from here could genuinely affect your savings, your investments, and the way you think about money in 2026. I'm glad you're here. This is Illusia. And today, we're going to give you the clearest, most honest picture of what is actually happening in the silver market. No hype, no guesswork, and nothing we can't back up with hard data. So let's get into it. To understand where we are right now, you need to understand what happened over the last 14 months, because this story actually begins back in 2025, when silver quietly started doing something extraordinary. In 2025, silver gained 147%, not 14%, not 47%, 147% in a single year. To put that in plain English, if you had put $5,000 into silver at the start of 2025, by the end of the year you would have had more than $12,000. That is not a typo. That actually happened. What drove that move? A combination of forces that had been building for years finally collided at the same time. The solar energy industry, which now uses over 200 million ounces of silver per year, roughly 1/5 of the entire global annual supply, was expanding at record speed. Electric vehicles, AI data centers, semiconductors, and advanced electronics were all consuming more silver than ever before, because silver conducts electricity better than almost any other material on Earth. It is not optional for these technologies. It cannot be easily replaced, and at the same time, mine production simply was not keeping up. The Silver Institute, the most credible independent body tracking global silver supply and demand, reported that by 2025, the silver market had run a structural supply deficit for 5 consecutive years. What that means in simple terms is this: the world was using more silver than it was producing every single year for 5 years in a row, and global silver inventories were sitting near decade lows. Less silver available, more silver needed. Basic supply and demand. Prices went up, but then came January 2026, and that's when things got genuinely crazy. On January 29, 2026, silver hit an all-time high of $121.64 per ounce. Not just a 52-week high, an all-time high. The highest price ever recorded in the history of silver trading. People who owned physical silver were watching their holdings double from where silver had been just a year earlier. The financial media was in a frenzy. Retail investors were piling in. Social media was calling it the Great Silver Squeeze, and for a brief electric moment, it felt like silver had finally broken free from decades of being undervalued and overlooked. But there was a problem. Buried inside that rally was something unstable, something that would unwind violently and very, very fast. Here is what was really happening. In China, retail investors, millions of ordinary people, not hedge funds, not Wall Street banks, had been piling into silver and gold at a staggering pace, using borrowed money, through leveraged futures contracts and exchange-traded funds. And the leverage, the amount of borrowed money fueling those bets, had reached levels that were completely disconnected from reality. One specific fund, the UBS SDIC Silver Futures Fund in China, had ballooned to trade at a 36% premium over its actual net asset value. 36%. That means investors in China were paying 36 cents extra for every dollar of silver they were buying. Not because the silver was worth more, but because so many people were chasing the same trade at the same time with borrowed money. It was textbook speculative mania. The Chinese government saw what was happening. Chinese regulators stepped in and began raising margin requirements, forcing investors to put up more of their own money and less borrowed money to hold their positions. When that happened, the leverage snapped. Traders who couldn't meet the new margin requirements had to sell, fast. And when everyone sells at once in a leveraged market, prices don't drift lower, they collapse. Silver fell nearly 50% from its all-time high to a low around $82 in a matter of days. Billions of dollars in paper wealth, gone. Now here is where it gets genuinely interesting for the average American, because that crash did not just happen in the background. It happened loudly enough that the United States Treasury Secretary felt compelled to comment on it. On February 8, 2026, Scott Bessent, the Secretary of the U.S. Treasury, appeared on Fox News Sunday Morning Futures, and what he said was blunt. He looked directly at the camera and described what had happened in the precious metals market as a classic speculative blow-off. He said things had gotten a little unruly in China. He specifically noted that Chinese authorities had been forced to raise margin requirements to try to stop the runaway speculation. And he framed the whole episode as a case of markets that had decoupled entirely from economic fundamentals. Now, when the U.S. Treasury Secretary goes on national television and uses the phrase speculative blow-off to describe what just happened to a major commodity market, that is not a casual observation. That is a deliberate signal. It is the government telling you, we watched this happen, we believe it was driven by irrational speculation, and we think the price movement was not legitimate. The CME Group, which runs the major silver futures exchange right here in the United States, had already responded to the chaos by raising silver margin requirements to 20% in late January. Bessent defended that move publicly. The message from Washington was clear. The system worked, the excesses got wrung out, and now the market needs to stabilize. But here is the follow-up question that nobody in the mainstream press seems to be asking. If the spike was just speculation, if none of it was real, then why is silver still at $90 an ounce right now instead of falling back to 30 or 40 where it was a couple of years ago? And that question, that very specific question, is exactly what we're going to answer right now. Here's the thing about Bessent's comments that got glossed over. He called the spike a speculative blow-off. And he was right. The speed and scale of that January rally was absolutely amplified by Chinese speculation and leverage. That is real, it is documented, and we are not disputing it. But here is the distinction that matters. A speculative blow-off describes the excess. It does not describe the entire move. You can have a genuine, fundamentals-driven bull market that gets temporarily hijacked by speculation. The speculation gets wiped out in the crash. But the underlying reason for the rally, the real structural reasons, those do not disappear when the speculators get margin called. And in silver's case, the structural reasons are formidable. Let's talk about the supply deficit, because this is the single most important piece of data in this entire story, and most people have never heard it. The Silver Institute, and this is not a fringe publication, this is the globally recognized industry authority on silver, has confirmed that silver will enter its sixth consecutive year of structural supply deficit in 2026. 6 years in a row where the world has consumed more silver than it has produced. And for 2026 specifically, the Institute projects that deficit to be approximately 67 million ounces. That means even with global silver mine output expected to rise about 1% this year, to roughly 820 million ounces, which is a 7-year production high, and even with silver recycling jumping 7% to over 200 million ounces, we are still going to end the year with a gap of 67 million ounces between supply and demand. The market has to fill that gap by drawing down above-ground stockpiles, and those stockpiles are already near decade lows. Now, some people will say, fine, but solar demand is slowing because manufacturers are figuring out how to use less silver per solar panel, and that is actually true. Silver now accounts for somewhere between 17 and 29% of the cost per watt of a solar module, which is a dramatic increase from just 3% in 2023. As silver prices climbed, manufacturers urgently started developing ways to reduce silver intensity, thinner silver pastes, different cell architectures, partial substitution with cheaper materials. The Silver Institute forecasts that solar silver demand will fall about 7% this year to around 194 million ounces. But here is the critical thing. The solar industry is still expanding overall. Global solar capacity is still growing by around 15% this year. They're using less silver per panel, but installing more panels. And in the meantime, other industries are picking up the slack and then some. AI data centers alone have become a major and rapidly growing new source of silver demand. Silver is used in the high conductivity connectors, in the power distribution systems, and in the cooling infrastructure of these facilities, applications where silver's physical properties are simply irreplaceable. The Silver Institute's December 2025 report, researched by Oxford Economics, one of the world's most respected economic research firms, specifically called out data centers and artificial intelligence infrastructure as a key structural growth driver for silver demand through 2030. Then you have electric vehicles. The automotive industry is on track to account for 59% of silver's industrial demand share by the year 2031. Every EV uses more silver than a traditional combustion engine car, for charging infrastructure, for power management systems, for sensors and electronics throughout the vehicle. As EV adoption accelerates globally, that demand is not going away. And here is something most investors completely miss. China is not just a source of speculation in silver. China is also restricting silver exports. Since January 2026, China has tightened its silver export licensing requirements, which is squeezing the global physical silver supply even further. So while Chinese speculators were blamed for blowing up the futures market, China's industrial and government policies are simultaneously tightening the physical supply of the metal that the rest of the world needs. That is a tension that is not going away quietly. Now let's zoom out even further because there is a macro story playing out here that goes well beyond silver specifically, and it involves your government, the Federal Reserve, and the value of the US dollar. Right now, the Federal Reserve is holding interest rates steady, but the market is pricing in 2 rate cuts later in 2026. And here is why that matters for silver. When interest rates fall, the US dollar typically weakens. When the dollar weakens, commodities priced in dollars, like silver, like gold, like oil, become cheaper for buyers in other currencies, which increases global demand and pushes prices up. Rate cuts are, historically, rocket fuel for precious metals. And it is not just rate cuts. In December 2025, U.S. retail sales growth completely stalled. GDP data came in soft. The economy is showing real signs of slowing down. When the economy slows, the Fed's hand gets forced toward easier monetary policy even faster. And easier monetary policy means a weaker dollar. And a weaker dollar means higher gold and silver prices. There is also the matter of the U.S. dollar index itself. As of late January 2026, the dollar index fell to its lowest level since 2022. A drop that Treasury Secretary Bessent himself acknowledged when he went on CNBC to deny that the U.S. was intervening in currency markets. The dollar has dropped more than 10% compared to a year ago. A falling dollar is a tailwind for silver that has nothing to do with Chinese speculation. And then there is the broader geopolitical picture. The Middle East remains unstable. U.S.-Iran nuclear negotiations are creating genuine uncertainty about oil supplies and regional stability. When geopolitical risk rises, investors seek safe haven assets. Gold benefits first and most directly, but silver, which has a dual identity as both an industrial metal and a monetary safe haven, follows. And right now, there are more geopolitical risks in play simultaneously than we have seen in years. So let's pause for a second and take stock of where we actually are. Silver is at $90 an ounce as of today, February 27, 2026. It came off an all-time high of $121 in January. It crashed to about $82 at its lowest point during the post-spike correction. It has now recovered to $90. The speculative excess has been wrung out by margin calls and regulatory intervention. What remains is a market that is sitting on top of a genuine structural supply deficit, supported by irreplaceable industrial demand from the world's fastest-growing technology sectors, with monetary tailwinds building from a weaker dollar and approaching rate cuts, and geopolitical risk adding a safe haven bid underneath it all. That is the setup. Now let's talk about what happens next. And that is where things get genuinely fascinating. Because the analysts who follow this market most closely are not predicting a boring 2026. Not even close. All right, you have heard the story of how we got here. You understand the forces that drove silver from $28 an ounce 2 years ago to $121 in January and back down to $90 today. Now here's the question every person watching this video actually wants answered. What happens next? Let's start with what we know for certain, the technical picture. Right now, silver is consolidating in a range between roughly $89 and $92 per ounce. Analysts at Oanda, one of the most respected market analysis firms in the world, have identified the $90 to $92 zone as a critical resistance zone. For silver to relaunch its upward move and seriously challenge the $100 level again, the bulls need to close above 92, cleanly and decisively. As long as price action holds above the $82 to $84 support zone, which represents the technical floor established during the January crash, the base case scenario remains consolidation followed by a potential breakout higher. CoinCodex's algorithmic price model is projecting a roughly 4.5% gain for silver over the next 7 days, which would put price around $92 by early March. That is consistent with a slow grind toward the 92 resistance level. It does not tell us whether silver breaks above or pulls back from that level, but it tells us the near-term momentum is upward, not downward. Now let's go bigger. What do serious credentialed institutions think silver does over the full year 2026? The range of forecasts is genuinely striking. On the conservative end, J.P. Morgan, one of the largest and most powerful banks on earth, projects silver could average around $81 per ounce for 2026. That would still be more than double silver's 2025 average price. BMO, TD Securities, and ICICI Direct are in a similar camp, expecting silver to remain elevated and range-bound, with the physical supply deficit providing a solid floor even during pullbacks. But the more bullish analysts are forecasting something dramatically different. The LBMA, the London Bullion Market Association, which essentially sets the global benchmark for precious metals trading, conducted a survey of forecasters, and the range of 2026 silver price predictions they received spanned from approximately $42 on the low end to $165 on the high end. That is not a typo. The same market, analyzed by serious professional forecasters, produced a range between $42 and $165. That tells you something important. This is an unusually uncertain, unusually volatile market, and anyone who tells you they know exactly where silver will be in 6 months is either lying or hasn't done their homework. What we can say with confidence, based on the Silver Institute's data, the global silver deficit for 2026 is projected at 67 million ounces, the 6th consecutive year of deficit. The market will have to draw down above-ground inventories to meet demand. And every year that goes on, the available buffer of stored silver gets smaller. The structural foundation beneath silver prices is not weakening. It is actually strengthening. Gold-silver analyst Alan Hibbard, who has been covering precious metals for years and whose 2025 forecast was remarkably accurate, has stated publicly that he expects silver to outperform 2025's 147% gain, and that he would not be surprised to see the price increase by over $100 per ounce from current levels to reach $175 or higher by year-end. That is an extraordinary prediction. And to be clear, it is not consensus. Most institutional forecasters are much more conservative. But it is grounded in a reading of the supply deficit and industrial demand dynamics that is factually defensible. Now let's talk about gold, because you cannot have a serious conversation about silver in 2026 without talking about what is happening in the gold market at exactly the same time. Gold hit its own all-time high on January 29, 2026, the same day as silver, by the way, reaching an extraordinary $5,594 per ounce. And like silver, it suffered a sharp correction immediately afterward, falling nearly 10% in a single day, its sharpest one-day drop in decades. As of today, gold has been struggling to consistently hold above the $5,000 level. And Scott Bessent, he commented on gold too. He used the exact same language. He called gold's move a bit chaotic in China, said it looked like a classical speculative blow-off, and noted that Chinese authorities were having to raise margin requirements there as well. Nikki Shields, head of research at MKS PAMP, one of the world's largest precious metals refiners, told CNBC that China had been the dominant driver, impacting prices across both gold and silver, driven by a mix of speculative inflows, retail and institutional, through ETFs, physical bars, and futures positioning. But here is the crucial context for gold that explains why Chinese investors piled in so aggressively in the first place. And it is not just speculation for speculation's sake. As Zhaopeng Xing, senior China strategist at ANZ Research, explained, Chinese people have extremely limited access to financial markets. They can invest in real estate, bank deposits, and a small number of other things. Gold, and by extension silver, became the most viable alternative when housing prices in China started falling and deposit rates dropped to around 1%. Currently, gold accounts for only about 1% of Chinese household assets. ANZ Research expects that figure to rise to 5% in the near future. That structural shift in Chinese household allocation toward precious metals is not a temporary phenomenon. It is a multi-year, demographic-driven trend. So while Bessent is correct that the speculative leverage in China contributed to the volatility, and it absolutely did, the underlying direction of Chinese investor interest in gold and silver is actually a long-term structural tailwind, not just a one-time frenzy. Here is another angle that sophisticated investors watch closely: the gold-to-silver ratio. This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, that ratio has averaged somewhere between 50 and 70. A high ratio means silver is cheap relative to gold. A low ratio means silver is expensive relative to gold. Right now, with gold around $5,000 and silver around $90, the ratio is roughly 55 to 1. That is within the normal historical range, but it tells you that silver has been catching up to gold in a meaningful way over the past 2 years. Many precious metals analysts believe that when the next major leg of this bull market begins, driven by the rate cuts and dollar weakness building in the background, silver will outperform gold on a percentage basis, as it typically does in the late stages of precious metals cycles. Silver's smaller market size and its industrial demand component both amplify its moves in both directions compared to gold. For gold specifically, the directional outlook is also constructive. 2 rate cuts are priced into the market for later in 2026. A potential new Federal Reserve chair aligned with President Trump's preference for lower rates could deliver cuts faster or deeper than currently expected. The dollar is already down over 10% from a year ago. Geopolitical risk remains elevated. And the U.S. government's fiscal position, with mounting debt and deficit spending, historically favors hard assets like gold and silver as hedges against currency debasement. One more thing worth noting on the gold side. Treasury Secretary Bessent himself, back in February 2025 at a press conference in the Oval Office, made comments about monetizing the asset side of the U.S. balance sheet for the American people, referring to the U.S. government's stockpile of over 8,000 metric tons of gold, which has been carried on government books at an artificially low price of $42.22 per ounce since the 1970s. Any formal revaluation of that gold, or any signal that the U.S. is moving in that direction, would be an earthquake for the gold market. It has not happened yet, but the fact that senior Treasury officials are even talking in those terms has not gone unnoticed by precious metals investors. So where does this all leave you, as a regular American watching this video on a Friday morning? Here is what Illusia believes you deserve to hear plainly. The Treasury Secretary was not wrong when he called out the speculation. The January rally was amplified well beyond its fundamental value by Chinese leverage and margin trading. That excess got corrected. That is over. But the structural story underneath silver, the supply deficits, the industrial demand from solar, EVs, AI, and semiconductors, the monetary tailwinds from coming rate cuts and a weakening dollar, the safe haven bid from geopolitical instability, none of that got corrected. None of that went away when the leveraged speculators got margin called. All of that is still sitting right here, under $90 silver, like a spring that has been compressed. Does that mean silver is guaranteed to go up? Absolutely not. The LBMA forecasters had a range from $42 to $165 for a reason. Silver is volatile. It can and does move in ways that punish overconfident investors. A stronger than expected U.S. economy could delay rate cuts and push the dollar higher, which would weigh on silver. A global recession could slow industrial demand enough to offset the supply deficit. Continued tightening of margin requirements in China could suppress futures-driven price discovery. These are real risks, but the probability-weighted view, the one that accounts for both the fundamentals and the risks, is that silver is more likely to be higher a year from now than it is to be lower. The 67 million ounce structural deficit does not resolve itself. The world's appetite for the technologies that require silver does not reverse. The monetary environment is moving in silver's favor, not against it. The path to $100 an ounce runs through 92. Watch that level. If silver breaks above 92 cleanly in the next few weeks, the road back toward the all-time high opens up. If it stalls there and fails to hold, expect more consolidation in the 82 to 92 range for the next several weeks before the next directional move. For gold, the directional setup is similarly constructive. A weaker dollar, potential rate cuts, geopolitical uncertainty, and growing Chinese household allocation toward gold all point toward higher prices over the medium term. Short-term volatility after the January crash is normal. The trend remains intact. Whatever you decide to do with this information, whether you buy silver, sell it, or just watch what happens, the most important thing is that you understand the real forces at play. Not the noise, not the speculation, not the panic of a single week's headlines, the structural reality. And the structural reality in the silver market today is one of the most compelling setups we have seen in years. If this video gave you something to think about, something you did not know before you pressed play, then Illusia did its job. We are going to keep tracking this story as it develops, and we will bring you the next update the moment something significant changes in this market. Drop a comment below. Tell us, are you bullish on silver? Bearish? Sitting on the sidelines? We read everything, and we want to know where your head is at. If you are new here, subscribe. We do not do clickbait. We do not do hype. We do real analysis with real data, spoken in a language that real people can actually understand. That is what Illusia is for. We will see you in the next one.